From LPL Financial, welcome to Market Signals.
Hello, everyone, and welcome to the latest edition of LPL Market Signals. Jeff Bookbinder here, equity strategist, LPL Financial. Pleased to be joined by Jeffrey Roach, our chief economist. It is a special edition of LPL Market Signals because we are recording live in Fort Mill, South Carolina at the LPL offices. And, so you're seeing a little bit of a different backdrop here just outside Charlotte. Jeff, it's great to be with you. Excited to be in the office and seeing a lot more people than I typically see in the smaller Boston office.
Well, it's great to be in person around the same table, not just looking at you through my computer screen. So great to be here.
It's great to know that I am a real person after a lot of Zooms. So let's get right to it here. We've got a great agenda for you. We're recording this on January 31st, 2023. Tuesday morning. As we always do, we'll start with just a recap of last week's market action. Certainly had some very interesting economic data last week, kind of a prelude to a big week this week. We will talk about the January Trifecta. I'll explain what that is in a little bit, but it's actually a really nice bullish development for stocks. We've got some comments on earnings season, and then we'll preview the week. Talk about the Fed, of course. That is probably the biggest news of the week, but there's some key data that Jeff will walk through. So let's get right to it, Jeff. First, last week's key themes. We got more evidence of falling inflation, certainly past peak with the PCE data, which we'll talk about. We got the GDP report, which the headline was good. The internals maybe not quite as good. So you'll provide some color to our listeners and viewers on that. And then the earnings season. Earnings has been lackluster, but it's probably about what people expected, and so it hasn't gotten in the way of at least a little bit of a bounce in stocks. Turning to just what worked and what didn't last week, what certainly jumps out is S&P was up 2.5%. Certainly we gave back a little bit on Monday, but very good week. NASDAQ did even better, up 4.3% for the week. And then international even stronger. So I think, Jeff, that's probably the first takeaway I would have when looking at all of these returns for last week is strong week for international.
Yeah, I just add, as we've talked and you hinted about it, about the whole peak inflation narrative. We're past peak. We saw this in the U.S. really since the end of the summer, beginning of the fall season. And it just took a little bit more time for the European markets to observe that inflation was past peak there. And so, when I look at this number for IFA, for example, really the last month in emerging markets for that matter, both were doing quite well. And I think in part because of an improvement in sentiment, improvement in an interest for investors to put on a little more risk at the table because they're starting to see some of the easing in inflation over there, like we've seen eased inflation over here in this country.
Yeah, it wasn't so much last week. You're right. The last month, European economy really much more resilient than most thought. So that certainly stands out here when you look at recent performance. If you turn, tech, NASDAQ was a big winner last week. The growth sectors, tech and sort of related tech have had a really strong start to the year. I think the theme there you want to pull out is the winners from last year have been the losers for this year and vice versa. So certainly the question for investors is how long will that continue? We actually don't think that run has much longer to go. So therefore we are still leaning toward the value sectors over growth. Certainly this week of earnings season will be key with all the big tech names to determine whether that growth run we've seen so far this year can continue. So let's move on to fixed income and commodities. So, we've talked about this certainly with Lawrence Gillum on fixed income. When you have higher yields and then yields fall, you get, you juice your bond returns, right? So over the last month, the broad bond market's up 3%. That's a really good month for bonds. So you started from a higher yield because rates rose. That was painful as it was happening, but boost your returns once you start falling again. All these bond returns, really, really good start to the year for bonds, and they're doing what investors need them to do. Not just providing defense, but giving you some income.
Yeah, one of the things I've been talking about is I've been out with clients a lot the last several weeks, talking about the bigger story that bonds will be like bonds again. I think Lawrence has highlighted that in some of our blogs and weekly market commentaries that you see on our LPL Research as well as LPL.com sites. And we think 2023 bonds will act and do what we normally expect them to do. If you look at that other matrix we have on this slide, one of the things I'd call out is just the energy index. And I think that's possible to see a little bit of reversion here. But I think the big picture, again, is, we had a cooler or less intense winter in Europe, so a little bit less demand in energy. Nat gas demand was a little bit soft in the European markets. And then, of course, a little bit of unknown about what the global economy will look like throughout 2023, and just a little bit softer demand. Hence, we see that showing up in the price action for the energy sectors.
Yeah, the energy sector has had a little bit of a slower start to this year. I mean, you can't expect 50-60% gains every year, certainly. So certainly that weaker natural gas performance is a big part of the challenge for the energy sector. So thanks for pointing that out, Jeff. Let's take a quick look at the S&P 500 here, and then we'll get into the meat of the discussion. I think this S&P 500 chart is really interesting because as our technical strategist Adam Turnquist points out, you've got a break back above the 200-day moving average, certainly a positive technical milestone, and we're kind of in that range, I guess. 4,100 is within striking distance. So if the market can get above that 4,100, we would see that as a very positive sign. And then you could talk about maybe a move up to, as high as 4,300, 4,350. So chart, we've had some chart progress. So we still in LPL Research are positive on stocks relative to bonds, but certainly have a little more work to do to break through to some of those higher technical levels. So let's move on and talk about the economic data, Jeff. The PCE inflation data, the PCE deflator, I think was the most important economic data point last week, more so than GDP.
Yeah, that's right. So we had a pretty interesting week last week from GDP numbers on Thursday last week, and then inflation numbers on Friday. And I think that did build the case for, as we want to tie in the previous chart to this chart with inflation, talking about we're getting higher highs and we're getting higher lows. And so that's kind of that definition of an uptrend. And I think, in this case, I'm showing actually both metrics of inflation, the CPI metric, which often gets more headline press, possibly not the best metric, as the Fed likes to say, their preferred metric is not CPI. That's the fixed basket of goods as tracked over time. What about in real time tracking what consumers are actually doing as relative price changes rotate from one to the other? And I think the bottom line is, we're past peak. And on top of that, you can say, all right, we can build the case that by December 2023, we might see the deflator with a 3 handle in that 3.2% range year on year. And I think that is giving a lot more confidence for investors to put a little bit more risk appetite in their portfolios. And it also, I think, helps the Fed think about, well, if rates are above core deflator rates, in essence, we finally moved into restrictive monetary policy. And then that might be a nice little teaser for something we're going to talk about in a little bit in this podcast on Fed policy.
Yeah, if you take nothing away from what we say here, I think that's probably the most important point. The Fed will be above the core PCE deflator after this rate hike, right?
That's right. That's right.
Really important point. That's restrictive. And then as the economy weakens further, they're going to have to think really hard about whether they want to hike again, or at least after March, which is likely to follow a rate hike here in February. So, you have a chart here, Jeff, about tightening financial conditions. This is why, and this is kind of the other side of the argument, the Fed has to be careful, right? If they tighten financial conditions too much, of course, they drive us into recession. But if they pause too early and drive market prices higher, you have easing financial conditions, and that can be inflationary. And then you're back to this stop and go, policy, monetary policy that was a problem in the 1970s, right? So, how does the Fed balance this challenge with tighter financial conditions?
Yeah, so just in sum, past peak, we're going in the right direction, and you might want to say, well, why? The so what and the why and how did this happen? Well, part of it is driven by what's explained in this chart. Think about last year, a lot of inflation was driven by supply constraint problems. Hence that blue line, supply-driven contribution to inflation was the major factor for the last really 18 months. Well, if you think about the latter half of 21 and most of 2022. And this chart basically shows that in more recent months, that's flipped. That inflation has been mostly driven by demand contributions. That's the orange line. That's exactly where we wanted things to go because the Fed has no power in their toolbox to address supply constraints. They do, however, can, as they tighten conditions, have an impact on aggregate demand and the demand-driven side of inflation. So I think you take this together and it kind of builds the case. I think investors are right to basically look at the market and say, yes, inflation's still elevated, higher than that 2% target, but we're going in the right direction. And we're going in the right direction because the Fed can actually do something about it. Because it's a demand-driven problem, the Fed can do something with those sets of conditions.
The Fed threading this needle was hard before, but it's not getting any easier, right? To balance all these on both sides of the equation. So Jeff, you've created this heat map, which I think is really interesting to show the progress on inflation across some different measures, and there are a lot of different ways to measure inflation.
Yeah, and I think this helps advisors and our listeners try to process what's happening in your kind of mainstream financial news networks. What is happening? Well, if you read left to right, we're getting green, except in that lagging category that is frustrating, and that's in the rents component. And that's kind of the bottom line from this heat map. The takeaway is there are sticky components, and not only sticky, but there are lagged components where everything else is improving, and it seems like rents are getting worse. I'll just put one note of caution. This is heavily influenced by existing rents. We know from the data that new rent prices have actually fallen too. And I think that's kind of the key, and maybe this is a little bit of a distracting component on inflation right now. The new rents component clearly easing the last several months. So this heat map will eventually get a little more green as we move throughout 2023.
Yeah, hopefully the Fed can focus on more of the real time and almost forward-looking reads on not just rents, but inflation in general. And they'll see that maybe being aggressive beyond March is too much. So that's a really interesting way to look at inflation. And, you can get a 3 handle on core PCE by the end of the year. The market's going to, I would think, have a pretty positive view of how 2024 might look as we get to the end of 2023. So let's go to GDP, Jeff. This is a really interesting report, and a lot of people probably just saw the headline and thought, "Wow, that's great. This economy is doing really well." But it's doing okay now. But when you break apart the pieces here, it's not quite as strong of a signal, is it?
Yeah, that's right. And the reason why this is helpful to kind of break out these contributions to growth is you look at that gray component, the change in inventories, added a fair amount to the headline number for Q4. That's never a good thing in terms of the drivers of an economy. Inventories are never going to be your category that gets you excited about growth. I think the way to think about that is we're moving toward continued softness in the economy, and the 2023 narrative between that softish landing and recession that potentially could be fairly short and shallow. I think we're setting things up, pretty nicely, Jeff, to think through that 2023, a little more volatility, probably the first half of this year. Expect a little more volatility, but things might be setting up pretty nicely for the latter half of 2023, where a little less volatility, a little more stability, a little more convincing data on growth from a macro standpoint.
Yeah, we'll talk about earnings quickly in a bit, but I think that's a story around earnings too, where you'll have this really lackluster first half, and then toward the end of the year, maybe you get a little bit more growth. Maybe the market's more comfortable with the inflation it sees, and you could have a little bit of a rebound in earnings, and you could have a positive market reaction to that, coming out of the trough. So maybe the economy, earnings, and stocks all follow a better path in the second half of the year. Forget about the second half of the year. We could have a really good year, all of it, if we follow this January trifecta pattern that technicians, Adam Turnquist included, are talking about. This is really powerful stuff. If you look at the years where we had a Santa Claus rally like we did this year, that's the last 5 days of December and the first 2 days of January, those 7 trading days being up, which they were. Then you start January with a positive first 5 days, which we did. And then you have an up January, which we will, barring an epic collapse today, right? Because we're up 4.5% coming into today for the month. So we're going to have a positive January. When all three of those things are positive, on average, you have a 17% gain for the year, and you're up 90% of the time. Right. I'll take those numbers any day of the week. So obviously we don't know for sure if we're going to get those returns, but this is setting up for a really strong year. And then we've also seen studies, we didn't do this ourselves, but if you have a down year before these indicators turn positive, the average gains are well over 20%. So we always say it, history doesn't repeat, but it rhymes. This is a very bullish technical setup. We also looked at monthly returns in years where you have this trifecta, and the gains are steady. So on average, you're up, every month of the year. Historically, this is dated back to 1950. Whereas if you don't have this trifecta, it's essentially just saying you have a strong start to the year. You see 5 months there on average, you're down. You have seasonal weakness, sell may go away, and all of that. So technically, from this perspective, we're set up for solid gains. But of course, the Fed's going to have something to say about whether we actually get the solid year that the trifecta would tell you we're going to get. So Jeff, I'll turn it to you as one of our key Fed watchers on the team. Are they going to kind of spoil the party because the market and the Fed are seeing a different path for rates?
Yeah, that's right. And just maybe just a quick little teaser for our LPL.com newsroom weekly market commentary component. So all this great data, charts, commentary that Jeff just highlighted on the Trifecta Santa Claus rally and what it looks like at the beginning of January, and then what it might look like for the end of this year for equities. It's helpful for those that want to continue to chew on this for a little bit more and think through this. That was the weekly market commentary topic for this week. So if you want more, go to the LPL.com newsroom. So
shout out to Adam Turnquist on that.
That's right. That's right. So
great work that he did putting all that together.
So there is this tug of war, as you kind of teed up for me here. The tug of war, I think, between expectations from investors and traders, and the tug of war with policymakers. So we do know from the latest press conference that the Open Market Committee members have said, hey, we're going to plan to hike next couple of meetings, then we're going to hold steady for the rest of 2023. The market is not buying what the Fed's selling. And I think the market is right. And I think the reason why is there's a little bit of that caution, I think, that the Fed wants to have in order to manage expectations, maybe talk a little bit tougher than they might say, because as you mentioned earlier, Jeff, in this podcast, that if there's too much of that expectation that things will ease up again, they're going to lose all the work that they did, last year with keeping financial conditions tight. So I think the big story is we know the data is slowing. We know the consumer starting to retrench. And so as the economy kind of enters this year with unsure footing, potentially outright contracting, we're starting to see that in a lot of the survey data, the Fed will focus and kind of re-energize their other part of that mandate, which is the growth mandate. Price stability, full employment or stable growth, and we know that that's going to be a refocus for the latter half of the year. So the market's expecting cuts as quickly as July. I think that's possible, but again, that has to kind of be in conjunction with seeing the weaker economic data. So I think the market's right. The Fed's wrong in this case.
Yeah, you follow the Fed much more closely than I do, but it seems to me that the market is saying we could have a recession, but yet the Fed could stay higher for longer, and those two things conflict, right? So of course we don't know if we're going to have a recession yet. But the Fed will respond if we do have actual contraction by the Fed's measures in the middle part of this year. So it'll be interesting to watch. I'll take the market in that bet, and but it'll take a little bit of time for us to see kind of who's right. So let's turn to earnings just really quickly. I mean, just a barrage. We get all these big tech names. Earnings season's been disappointing so far. There's just no way around that. We've actually missed earnings targets by a full percentage point so far, which is extremely rare. But technically, I don't think we've missed an earnings season by that much since the financial crisis. So, because typically estimates come down enough to be exceeded, and we may still get there, but no doubt this has been disappointing. But what's interesting is that the market's gone up anyway, right, Jeff? I mean, it's almost like the better than feared narrative, right? Expectations got so low that even bad news was well received, right? There was so much bearishness coming into the year. So, these numbers aren't great. Missing on earnings, seeing estimates come down for 2023, probably a little faster than I had expected, but we're still at 225 in S&P 500 consensus earnings for 2023. Down from about 230 when earnings season began. Maybe we go down a little bit more, but a lot of those cuts have already occurred, and maybe the market is kind of seeing the other side, right, of this. We'll call it malaise, and the reaction hasn't been too bad. So I think that's probably. I'll just leave that there, and we'll just watch the Apples and the Amazons and the Metas. Google, just a huge number of big names. We've already had some big names this week too, and they're hanging in there, but clearly it's a tough environment. So don't look for earnings season to be much of a catalyst in the near term. I think that's the most important takeaway. But we also don't see a collapse in 2023 like many anticipate. So Jeff, let's go to the key events for the week here. Obviously the Fed, we kind of covered that a little bit already. But we also have ISM data. We have payrolls. What are you watching this week that you think could be market moving, where maybe the market gets a little bit surprised?
Yeah, I think it's helpful, for all the viewers that are here. Here we are recording again on Tuesday morning. One of the big things I think we need to be prepared for is on Friday we'll get the January payroll estimates, and the markets have been a little bit, under the luxury of fairly stable non-farm payroll reports. So, for those of us that have been in the business for a while, remember and should always remind ourselves that the monthly payroll reports can be highly volatile. You think about the details of the report, and the range can be plus or minus a couple 100,000, right? Where you look at the statistical ranges, and so you want to remember we've been under the luxury of just regular 200 plus gains over the recent months, and even farther back we've had some really strong reports. We should, I guess, bottom line, remind ourselves this can be choppy. I don't expect a negative number for Friday, But in terms of just remembering those expectations, this can be very choppy, and it's helpful to always look at these things with a 3-month average and perhaps even a 6-month average when you look at these month to month, because there's some volatility as well as heavy revisions, particularly during these times in the cycle where we're coming from, the reopening phase to this slowdown phase in this year. So revisions will eventually be very important to watch. But overall, if you look at just the job data, it's been a soft landing, and it's been still a very solid job market. So taken in conjunction, tomorrow we'll hear from the Fed chair. Take those comments along with the Friday morning payroll report, and that's going to be very important for building expectations for the rest of this year. The labor market is still very tight. We're starting to see a little less churn, a little less tightness, and actually a little bit of easing in average hourly earnings. So that's going to be key for these upcoming reports.
So is bad news still good news?
Yeah, the bad news, good news. I think if we can see convincing data that we're not going to have a wage price spiral, inflation is coming off, weak numbers, but not too weak, will be what the market wants. The market will want to see 175,000, maybe even a 150K gain in January. That'll be good news.
Be very interesting to watch. So, turning back to the Fed, we'll get 25 basis points, and then we'll probably get another 25. And then we think that's where you get the pause. But of course, that won't be evident to the market for at least a couple more months. We will have to see. But that we think will be a catalyst. The Fed pause, maybe not a pivot to a cut, but the Fed pause, we think will give stocks a little bit of a boost. And maybe that's a little bit of why we've seen this rally so far this year too. Even it hasn't been a huge rally, but certainly market looking ahead to an easier Fed in the not too distant future. So let's wrap up by just highlight these big name earnings reports. I mean, it's dizzying, frankly, how many big names report this week. We talked about mega cap tech coming, and then you've got some big energy names. You've got some big healthcare names, industrial names. So it's just going to be a whirlwind. I think after this week, we'll have a really good handle of what the near-term earnings outlook is. So we'll certainly report back on what it looks like next week. I don't think there's any other data here, Jeff, this week to really highlight. So let's just end it there. Thanks everybody for watching. Great to be with you, Jeff, in person, live for Market Signals. Hopefully we can do this more often. I don't know. I'll rack up some frequent flyer miles, but we'll see when we can do this again, because this is a lot more fun than just looking at the Zoom screen. So we'll be back with you next week. Looking forward to seeing all of you there. Thanks, Jeff.
Take
Thanks,
care.
everybody.